Expected to see Ryan Seacrest and Beyonce in concert over the lunch hour, you're in the wrong place. If you expected to see the 30-minute real estate connection, you are in the right place. So welcome. We're going to take about 30 or 45 seconds to let everybody check in, grab a sandwich, a drink, and we'll get started in less than a minute. Thanks for being here. Good afternoon, everybody. I'm Dave Sullivan, a shareholder at Perkins & Company and the Director of Business Development for the firm. And welcome. Over the next 30 minutes or so, we hope to bring you some very valuable, important information. This is being put on by Perkins Real Estate Team. We call it the Real Estate Connection. We've been doing this for the better part of 5 or 6 years. And let me just say, we miss seeing all of you in person, but we hope that this is at least a reasonable alternative until we can all be together. So our real estate team is very committed to bringing you timely topics. And so what we're trying to do, we've posted 3 of these and we have more upcoming. We'll keep you informed about them. A reminder that this session is being recorded and you'll be able to share it or watch it later. You can share it with friends. The PowerPoints we'll be showing you are also going to be sent out. So we'll be sending the recording and the PowerPoints out to everyone. And also a reminder, in the bottom of the screen, you have a Q&A button. Feel free to use that and we'll do our best to answer those questions. My guess is we probably will during this 30-minute presentation. If we have time, we'll get to them at the end. And if we don't, we'll answer those questions and send them out to you afterwards. So today we actually have a very packed program. We have 3-star talented topics presented by 3 fabulous people, all from Perkins. And our presenters are Kim Spalding, who is a shareholder on the tax side and one of the leaders of our legacy planning group. Next is Paris Powell, also a shareholder and the leader of our business valuation practice. And no stranger to many of you is Mr. Tim Kohlberg. He's a shareholder on the tax side and one of the leaders of our real estate team. Kim will address timely estate planning ideas. Paris will share how you can supercharge your estate planning with business valuation, and Tim offers a reality check on debt workouts. So without further ado, I welcome Kim Spalding.
Thank you, Dave. Like you said, we wish we were in person with you, but we didn't want that to hold us up from passing along this time-sensitive information. We're at a unique point in time in the history of our estate tax. For many years, the exemption was low and rate as high as 55%. It's only in recent years that the exemption was increased and rates lowered to 40%. Each person has currently over $11.5 million of exemption available. There's concern in the profession that if there's a change in the White House and Senate, that the exemption will cut in half prior to 2026 when it's currently scheduled, and potentially be reduced even further. Our Ninth Circuit Court of Appeals has ruled that a retroactive tax increase, including a change to the exemption, does not violate the Constitution. This means we may see changes effective as early as January 21. Consider taking advantage of the high exemption while we have it. If you're interested, we encourage you to act soon. The planning takes time, and the estate planning attorneys will likely be busy. Gifting today removes future appreciation. It also permanently saves the state estate tax. It's important to remember that Oregon and Washington don't tax or track lifetime gifts, and that their exemptions are much lower than federal. Oregon's $1 million and Washington's $2 million indexed. Our low interest rates today present additional opportunities. For example, a parent could gift their child almost $2 million and the annual interest wouldn't exceed the annual exclusion of $15,000. For existing notes, you could consider renegotiating to the lower interest rates. The September rates were recently announced, and the short-term loan, which is up to 3 years, is 0.14%, midterm 0.35%, and only 1% for long-term, which is notes 9 years or longer. There are a variety of techniques to maximize the value of your gifts and leverage use of the exemption. Some strategies include gifting to a spousal lifetime access trust, which allows flexibility and access to the assets if you need them in the future. There's also grantor retained annuity trusts, charitable remainder trusts, and charitable lead trusts. The low interest rates we have today make some of these strategies even more powerful. If you prefer to wait until the outcome of the election is known, one option is you could sell assets to a trust in exchange for a note. And if the sweep occurs in November, you could forgive the note as a taxable gift to make use of your exemption. For additional flexibility, you could make a gift to a lifetime Q-tip trust. You can make the election when you file your gift tax return next year. Q-tip trusts are established to benefit a spouse and pay income during lifetime, and they allow you to make an election so that you can use your exemption for part of it and marital deduction for the other part. It's always important to keep in mind the step up in basis for income tax. When you're giving away low basis assets, you're increasing the income tax in future years if you ever sell the property. So careful consideration should be given as to which assets you're going to give away. With all of our recent stimulus, we know there's going to come a time to pay, and things may not get better than they are right now, at least in terms of estate planning opportunities.
Hey, Kim, I've got a question for you, and maybe some of the people in the audience might have a similar question. And it relates to your comments about the step up in basis for income tax purposes. Obviously, a lot of the audience has real estate that they own, whether it's through a partnership or directly. So is there a cut and dried methodology or decision matrix in terms of how do you decide whether to leave assets, especially real estate assets, inside of an estate and get the step up versus gifting now?
That's a great question, Tim. It really depends on the facts and circumstances, and there are a number of factors that we need to analyze. One of the most important is the amount of gain that's on the property, which is obviously determined based on the basis, and that's the amount that will be subject to income tax. So we compare that to what would be subject to estate tax, which is based on the total value of the property, but a lot also depends on where the person is living and where they die, because the states vary widely on the taxes that are imposed. For example, California doesn't have an estate tax. Oregon has an upper end of 16% once an estate reaches 10 million, and Washington rates reach all the way up to 19%. So it really depends, and it's something we need to analyze. So I'm going to hand it over to Paris. She's going to talk with you about the valuation and the important next steps if you decide you want to move forward and take advantage of some of these planning opportunities.
Thank you, Kim. Appreciate that. As you would expect, Kim and I work very closely together on the estate planning issues. Excuse me. So, as she mentioned, with the uncertainty around lifetime exclusion limits combined with some possibly lower values of operating companies and some real estate, and earlier this year, marketable securities, those two things combined together create an opportunity for transfers. Right now, some clients are planning gifts up to and as of December 31st, but doing so with preliminary values now that we're working on using interim information, and so that they can get that information to their advisor team and start making recommendations and then updating it to December 31st or whatever that transfer date is, with a valuation report that would be used for the gift tax filing. So if any of this sounds like it might be a good fit for you, some of the next steps to begin this process, some of these happening simultaneously, would start with pulling together your advisor team. That includes your estate planning attorney, the business attorney, if they need to do any restructures and changes to the entities themselves, or any shareholder or buy-sell agreements. This also includes your CPA, of course, business transition and succession planning advisor, a financial advisor, your company's CFO if you have one, and maybe any other key advisors that you work with. With this planning opportunity, as Kim mentioned, many of these professionals are already filling up their fall capacity, so it's really important to pull everyone together on the front end and make sure that everyone knows what's in process, and so that they can set aside time to make sure that you've got clear deliverables and timelines to make this happen. For holding companies, real estate appraisals need to be scheduled, preferred Those are definitely preferred, especially with larger gifts or assets. With a business valuation to follow, that's just where we come in, is to value the interest in the entity itself, the wrapper essentially around the portfolio of assets. We aim for that real estate appraisal, the as of date, to be within 60 days of the business valuation and then within 60 days of the transfer. The ideal would be that the real estate appraisal, the business valuation, and the transfer are all happening as of the same date or close to, so that it creates more of a bulletproof back pattern for documenting your gifts. For example, if if you have an interest in a real estate holding company and you want to gift one of those interests, that is going to involve those two experts, and I want to explain how they work together. The real estate appraiser actually values the underlying assets, and then the business appraiser follows behind and values an interest in the entity, that little slice of ownership, unless the real estate appraiser is qualified to complete evaluation of an interest in an entity, including all assets that are held in the entity, along with discounts for lack of control, marketability, or voting rights. I will note it is helpful to share the requested information with both experts. So if you're already providing information to your real estate appraiser, it's good to CC your business valuation experts so they don't have to ask for the same information, create a little efficiency. For the operating entities, you'll likely only need a business valuation expert unless you have, say, certain significant or unique assets held in the company, such as real estate, investments in other entities. That's something that we come across more often, is layered entities. Another thing that you're going to have to work through is determining how much is going to be transferred, either a certain dollar or a percentage. And it's incredibly important, I will bold this, incredibly important to analyze the cash flow and verify that your long-term financial security is maintained after gifting the interest, because whatever cash flow pertains to that ownership percentage is going to then go to the recipient of that gift. So a financial advisor or business transition and succession planning advisor, they might use a Monte Carlo analysis to provide reasonable certainty that you're going to have sufficient assets for your financial security. They use this simulation to model out the probability of different outcomes and give you some confidence that you're going to have enough assets to live out your lifetime. I will note that some estate planning attorneys utilize a formula allocation clause, sometimes called a Wandry clause, when the aim is to transfer a specific dollar amount of a very hard to value asset. For example, a company versus just a stock portfolio. That's a legal issue though, and it's up to your estate planning attorney to advise. So another consideration that you're going to be working through in terms of value and the impacts to it is if you're going to be transferring control. Any voting or non-voting kind of changes, are you going to be gifting non-voting shares in a company? And if there's going to be any change to like a manager managed LLC or a member managed LLC, anything like that. Other things that might change as a result of this gift that you might want to work through is if you would like to make any changes to current operations or the cash flows, any salaries or guaranteed payments that might need to change, as well as maybe if you're working with a related entity, adjusting your market rates or your rents to market rates. The next step then would be obtaining the appraisals, the real estate and or business. And depending upon if you are transferring that certain dollar amount, say $11 million of a company, then that valuation would likely need to occur prior to the gift, so you know how many shares that equates to. If you instead know that you're going to gift 25% regardless of what that value comes in at, then you could actually complete that valuation at a later date, as long as it's before the due date of the gift tax return, which is currently April 15th of the following year, or October 15th if it's extended. The next step would be executing any of these amendments to the buy-sell agreements, operating agreements, recapitalizations, transfers of ownership, all of that coming together, and then filing the gift tax return. Our goal is to outline this so you have all of the action items that you need to get the ball rolling if you're interested, and that you have sufficient time to do this and evaluate all possibilities, make an informed decision. We know that there's a lot of considerations, as Kim mentioned, the income tax versus the estate tax, cash flow needs, control, other objectives and goals for your wealth and your legacy. So we know that it takes time to pull all this together and end up with an outcome that you're incredibly pleased with. Next, I'd like to transfer it to Tim, unless there are any questions that have come in.
So Paris, I don't know if there has been any questions come in, but as you were speaking through this, something popped into my mind. And when you were talking about the kind of the as of date and the timing of the appraisal, you said 60 days as of the end or within proximity of the date of the gift. So does that mean that everything has to be teed up and that you're able to get an appraisal done within 60 days? Or how does that work in terms of timing?
That's a really good question. When I'm referring to those dates, those are the as of dates, meaning what was, you're taking kind of a snapshot in time and what was known and knowable as of that point in time. So what was the value of this asset as of this date? The best example that I have for thinking about this is maybe what would a company in the travel industry, what would the value of that be on September 1st versus if you had following 9/11 or prior to 9/11, sorry, versus valuing it after 9/11. If you look at those two things and you had a valuation date of say September 10th versus September 15th, things are wildly different as far as expectations and everything that's going on in that industry. So that's what we're talking about when we mention valuation dates. We say we are valuing this company as of December 31st. However, the report might not be issued until October of the following year.
Great. Thanks, Paris. Appreciate all the input from the two of you. Very helpful. The last stage of this presentation, we're going to change gears a little bit, and we're going to talk about debt workouts and the tax consequences associated therewith. This is a little precursor of what may come. Hopefully those that are listening to us are not in this situation, but if you are looking down the pipeline of something like this to happen in the future, some tidbits for you to consider and think about. Cancellation of debt income, which results in any time you have debt forgiveness and a debt workout, whether it's from retirement or extinguishment of existing debt or a debt to equity conversion. For instance, if you transfer a partnership interest to a lender in exchange for canceling their loan, or if you have issuance of new replacement debt for old replacement debt. Any of those situations can trigger these tax consequences. Cancellation of debt income is governed by Section 108 of the Internal Revenue Code. And the general rule is that cancellation of debt income, or COD income for short, is included in taxable income unless you can exclude it. And it's includable as ordinary income unless you can exclude it. On this slide, you'll see a couple of examples of what is not COD. The loss deductions is basically geared toward a cash basis taxpayer. So for instance, if you had accrued expenses that you hadn't deducted yet and they were forgiven, that's not going to be taxable ordinary income to you because you never got the benefit of those deductions. In the capital transaction one, I'll come back to in a few minutes. So this slide outlines the various exclusions that are key to our industry, the real estate industry, as well as a lot of other businesses that are going through and suffering hard times in this day and age. These are outlined in the code. The first one is a Title 11, which is a bankruptcy exclusion. So if you're under the court jurisdiction and you're in any type of bankruptcy, whether it's Chapter 7, a liquidation type mode, or a Chapter 11 restructure reorganization mode, if debt is forgiven within bankruptcy, you're able to exclude it with certain exceptions that I'll talk about. The second exception is insolvency. Here, the test is, to what extent am I insolvent? And I can exclude it to the extent I'm insolvent. How do I define insolvency? Well, it's a simplistic calculation, but there's a lot of nuances and complexities associated with it. It's essentially, what's the amount of debt that I have at the time of forgiveness or modification compared to the fair market value of all of my assets. And in my all assets calculation, I have to include what otherwise would be excluded assets in bankruptcy, such as your primary residence, IRAs, some of those type. Qualified farm debt is another exclusion. I'm not going to talk about this one in this presentation. The other one key to our area is the qualified real property debt. What is this? Well, it's debt that's secured by real property, and it's got to be acquisition debt as defined in the code. What is acquisition debt? It's debt that's incurred to acquire, develop, redevelop, improve your real estate. So that's the requirement for it. This provision is elective, and it gets trumped by the Title 11 and insolvency exclusions. And essentially what happens is that you get to exclude the lesser of the amount of debt over the fair market value of the asset, or your total basis and all depreciable real property. So there's two tests that you have to look at when doing that. Lastly, on the qualified principal residence debt, that is in play through the end of this calendar year until it's extended. And essentially it allows you to exclude up to $2 million of debt forgiven or relieved on your primary residence. And when we're talking about primary residence, we're not talking vacation home, second house. It's got to be your primary residence. A couple of other quick comments on this slide. You will see that it kind of lays out where it's tested at. So it's beneficial in the corporate scenario because you're doing the testing at the entity level for most of these types of exclusions. Whereas conversely, where we see a lot of our real estate, it's in partnerships, LLCs. Unfortunately, that test and all of these testings are done at the individual partner or member level. So if your partnership's in bankruptcy, but you individually own an interest in that partnership, and you're what we would call hopelessly solvent, which means you're not insolvent, then unfortunately, you're not going to be able to rely on the bankruptcy exclusion, and you're going to have taxable ordinary income from that. Also, the other comment is related to disregarded entities here. And essentially, there we're talking about single member LLCs or grantor trusts. Those won't protect you either. So essentially, you're looking through to the underlying owner and doing the testing at that. One quick comment on this before I move on. So there's a planning tech thought here. If I see the writing on the wall, should I rush out and convert to an S Corp or a C Corp from my partnership? The answer could be maybe, but there's some tax traps there. So before you go out and do that, you definitely want to talk to your tax advisor. I earlier mentioned about capital transactions being outside the scope of COD income. Well, how can that come about? The devil's in the details here, and it depends really ultimately on whether the debt we're dealing with is recourse debt or non-recourse debt. And how do we determine whether it's recourse debt or non-recourse debt? Well, recourse debt is essentially any debt that you're effectively personally liable for. Non-recourse debt is obviously the inverse of that, debt that you're not liable for, whereas they could take the asset back, but they can't come after you for anything above and beyond that, for instance. Now, one comment I want to make on this characterization of recourse and non-recourse debt, we know a lot of us in the real estate industry, debt gives us basis for purposes of deducting losses. So do we look to those rules under the partnership tax law provisions to determine this characterization? Or conversely, there's some rules under the gain loss on sale of assets where it's a different section of the code, and the rules there might be a little different and defer to state law versus federal tax law. Most commentators, including ourselves, believe that the right answer is you've got to look at the gain loss on sale. So those rules, and not how you allocate debt on partnership returns, are the ones that govern. What happens if you have a non-recourse debt that's forgiven, or you have a deed in lieu transaction, give the property back, or foreclosure, or a short sale? Well, unfortunately, there's a Supreme Court case, the Tufts case, that was ruled a long time ago, and it essentially says that if you're relieved of non-recourse debt and you transfer property in satisfaction of that, it's basically a sale transaction, so you won't have any COD income, therefore no exclusion. So the difference between the debt and your tax basis in the property is going to be taxable gain loss on sale, as if you sold it in a normal sale transaction. Converse and compare that to recourse debt, and in there the comparative is the difference between the COD, or the amount of debt, over the fair market value of the property. That delta is COD income, and then the fair market value of the property compared to your tax basis in that property is going to be the number that you use to determine gain loss on sale of transactions. So you have a bifurcated transaction where you still have gain loss on a sale, but you also have COD income that you might be able to possibly exclude. There are consequences to the exclusion, as you can see on this slide, and there's also some elections in terms of the ordering and how that happens. Generally speaking, the consequences happen after you determine the tax in the year in which the forgiveness takes place. In terms of the attribute reductions here, the credit items are reduced 1/3 of a dollar for each dollar of forgiveness, whereas the non-credit items, such as net operating loss or capital loss carryovers or basis, those are a dollar for dollar reduction. And if you still own your home and you had the qualified personal residence exclusion that you took, there's a cost to that as well. And that is, you have to reduce the basis in your primary residence to the extent of the basis you have. And this is done on a Form 942, which is filed with your return for the year in which you have the debt forgiveness event. And you turn it in, and you make the elections via that 982 form as well. So with that, I think that kind of concludes the comments I wanted to make specific to it. I know it's been fast, a lot of material, but we wanted to at least hit the high points. And as we shared in our last connection event a couple weeks ago, these are some items that we're monitoring and we'll talk about, time permitting, in future events.
Fantastic, Tim. Thank you so much. I wish we had virtual clapping right now, but in lieu of that, everybody, we have 46 people. Everybody clap right now. And Tim, Paris, and Kimberly. Kim, thank you all so very much for the presentation. A lot of work went into preparing for this. And I also want to thank the real estate team that are involved in behind the scenes in many different ways. And want to thank Michelle Wright also for all of her great work behind the scenes. Thank you, Michelle. So just a reminder, this session has been recorded. So we will send that out to you tomorrow, and along with the PowerPoint. And as we have upcoming events, we will let you know about those. And I'd also urge you, if you have any questions that you want to ask any of us at Perkins, just drop us a line, particularly if you have some topics you'd like to have us cover for the next Real Estate Connection. But you can rest assured that we'll be doing something in the fall that will be very, very timely. We thank you all for joining us. And again, a reminder to seek good advice from your tax accountants and the folks here at Perkins. If you're a client, reach out to us, because we know that facts and circumstances dictate so much of this, and it's complicated stuff. If you're not a client, we urge you to give us a call if we can help you. So thank you all very much. We appreciate you being here. We know you have a lot of choices. Have a great afternoon. Stay well and strong. Bye-bye.